First off, big news, overnight rate is holding steady at 5%. The bank's also sticking with their quantitative tightening policy. So the target rate is also referred to as the overnight rate. So it's their interest rate at which major financial institutions borrow or lend one day or overnight funds amongst themselves. So globally, things are slowing down a bit. In the US, the economy has been quite lively, mostly because of robust consumer spending, but it looks like that should cool. Reason being is there's definitely a more of a lag in the economy when it comes to interest rate increases in the US compared to Canada, because of the fact that so many people down in the United States have long fixed term mortgages. So they might have actually very low interest rates for an extended period of time. So the only people that are actually impacted would be your adjustable rate mortgage holders down there, which is a smaller percentage than in Canada, and then anyone that's sort of selling and buying or getting a brand new mortgage. So it's a lot less immediate impact to their economy. So that's where they should probably take longer to see things improve. Whereas in Canada, we're seeing a lot more people impacted sooner because of the fact that we have a larger percentage of people in a variable or adjustable rate mortgage. Remember, adjustable rate meaning payment automatically changes. Variable rate is payment static, but the interest changes over time. So that's the big difference between the two. So what we're going to see here is the economy here is a bit of a mixed bag. We hit a rough patch in the third quarter after decent growth earlier in the year. Higher interest rates are making everyone think twice about spending, and it seems to be sort of dampening spending, which makes a lot of sense. The job market is showing changes too. Job growth has slowed a touch, and unemployment's ticked up a little bit, but wages are actually still on the rise, which a little bit silver lining in terms of the costs and expenses out there. And inflation eased down to 3.1% in October, so mostly thanks to falling gas prices. But the cost of housing, rent, still going up, and that's definitely impacting inflation as a whole. So I think the takeaway from today is the bank is they're kind of on a fine line. It's like, have they gone too high? Number one, which could very much be the case, and probably is the case when we look back at this years from now. But they're also, their goal is to bring down inflation, but at the same time not sort of kill the economy. But at the same time, like a few economists I really like to follow have said, is they would much prefer a recession, because they know how to handle that, than persistent ongoing inflation. So to me, I think just with the data and what we're looking forward to now is the question really isn't, are they going to raise rates further? As of today, it looks like the big question is, when are they going to cut interest rates? Because what we're coming up to when we're moving into 2024 is we now have this large scale renewal wave coming with $300 billion in mortgages up for renewal next year. There's going to be a lot more people impacted. And for the long time over this rate cycle and there's rate increases, there haven't been that many people impacted at a large scale when it comes to mortgages. Because generally who's impacted are people that are in a adjustable rate mortgage. So the one where the payment automatically changes. On top, the variable rate mortgage holders, which we hear about a lot, aren't actually impacted. And when the Bank of Canada talks about, the amount of people that they're analyzing that have had payment changes, well, they're bulking in variable and adjustable together. And in reality, variable hasn't actually, not everyone in a variable rate mortgage has had a payment increase, right? There's a lot of negative amortization scenarios. There are people that have extended amortization situations if they haven't been able to keep up with payments, pushing it out to 40 years and things of that nature. So there's been a lot of band-aids and things that have sort of prolonged the impact of higher interest rates. So now that we move into next year, when we start to see a larger renewal wave coming, there's no hiding anymore. And everyone's going to sort of start to get put into these higher interest rates. So there's if we don't see rates come down, whether it's fixed rates, which we can potentially see happen if we still continue to see bond yields ease, then with that happening, then it might alleviate some of that. So more people might be looking at a fixed rate scenario just because it's a lower payment or lower rate today than it is on the variable or adjustable rate side. But with the fact that we probably see rate cuts sometime next year, just a matter of when, then it'll be interesting to see how the market plays out and what actual cash flow impact that has on homeowners and especially real estate investors or residential real estate owners. And are they cash flowing properly? Because that's been a big trend is investors selling properties that just aren't, the numbers just don't work very well anymore. So we'll have to keep an eye on those things. Next announcement's in January, so we'll update you then. Hope you're having a wonderful start to the holiday season. Any questions, always here to be of service. So please let us know how we can help, and hope you have a wonderful day, and we'll talk to you soon.